Investors, hello. This is Stock AI Insights Earnings Analysis, and I'm your Chief AI Analyst. Today, my systems are parsing the Q3 2025 earnings from H World Group, which were just released today, November 17th. And let me tell you, the data reveals a fascinating story about a very deliberate and powerful strategic shift.
But first, the important bit. This content is for educational reference only and is not investment advice. As you know, investing always involves risk. Okay, with that covered, let's get right into the numbers.
So here's our game plan for today. We'll kick things off with the quarterly highlights. Then we'll really dig into the revenue growth. After that, we'll see how that translates to profitability, peek at their forward-looking guidance, and finally, I'll give you the analyst's verdict based purely on the data.
All right, first up, the quarterly highlights. The big headline for H World this quarter is simply put, strength. But, this wasn't just a lucky quarter. It's the direct result of a very specific strategy.
And this quote from CEO Jinhui, it's the key to understanding everything we're about to see. That phrase, asset-light strategy, that's our theme. It basically means focusing on franchising and managing hotels, rather than owning them outright. And as we'll see, that single decision is changing the entire financial makeup of the company.
So how does this asset-light idea actually make money? Let's get into the revenue analysis and see this engine in action. The top-line number is nearly 7 billion RMB in revenue for the quarter. That's an 8.1% jump compared to last year. Now, what's really interesting here is that they actually beat their own forecast, which was for a 6% increase at the high end, so they outperformed their own expectations. The big question is, how?
Well, the answer is right here. It's really a tale of two different businesses inside one company. On one side, you've got their monetized and franchised revenue, the M&F business. That's the core of the asset-light strategy, and it absolutely skyrocketed, up 27.2%. But on the other side, revenue from their traditional leased and owned hotels actually went down by 5.5%. This isn't a problem. It's the plan. They're deliberately shifting focus away from the expensive, capital-heavy model and hitting the accelerator on the high-growth, asset-light one.
And this isn't just some abstract concept on a balance sheet. You can see it in their physical footprint. In their main China market, they opened a whopping 749 new hotels this quarter. Even after closing 185 locations, that's still a net gain of 564 new spots. And get this, of those new openings, almost all of them, 746 to be exact, were under that M&F model. It's proof positive of how aggressively they're rolling this out.
Now, look at this chart. You can see that solid 8.1% overall revenue growth pretty clearly. But the key thing my systems are flagging isn't just the growth, but what's driving it. The legacy Huazhu part of the business grew by a powerful 10.8%, and that growth was almost entirely fueled by that M&F surge we just talked about. It's a high-octane engine that's more than making up for declines in other areas.
Okay, making more money is always good, but the real test of any strategy is what happens to the bottom line. So now we're moving on to profitability and margins, and honestly, this is the real aha moment in this whole report. Adjusted EBITDA, which is a great way to measure a company's core operational profit, grew by a very impressive 18.9% year-over-year. Think about that for a second. Revenue grew by about 8%, but profits grew by nearly 19%. That's a huge sign of improving efficiency and expanding margins. It means the company is becoming more profitable with every dollar it brings in. And we don't even have to guess why this is happening. The company spells it out for us in their press release, stating the margin improvement was mainly due to a higher revenue contribution from our M&F business. It makes perfect sense. Franchising doesn't have all the heavy costs like rent and big payrolls that come with owning a hotel. So as that part of the business grows, it naturally lifts the profitability of the whole company.
Look at this chart. This is that aha moment I was talking about. This is the visual proof. Just 1 year ago, the M&F business was responsible for 59% of the company's gross operating profit. This quarter, that number has jumped all the way to 70.5%. The part of the business that's smaller on the revenue side is now generating over 2/3 of the profit. That's the incredible power of the asset-light model right there.
So Q3 was clearly strong, but what does the road ahead look like? Let's turn to the company's own official forecast for the fourth quarter.
Now, their guidance for Q4 tells us this story is far from over.
They're projecting total revenue to grow somewhere between 2 and 6%. But look at the M&F segment. They expect that to grow between 17 and 21%. This huge difference tells you everything you need to know about where their focus is. They're signaling that the asset-light engine is going to keep running at full throttle, even if the overall company's growth rate looks a bit more moderate.
And the CEO's closing statement really drives this home. Jin Hui talks about high-quality network growth, which is basically code for adding more franchise locations and grabbing market share. It's a clear signal that they are doubling down on the very strategy that made Q3 so successful.
So, after processing all the numbers, the quotes, and the strategy, what's the final analysis of this quarter? Let's bring it all together.
Based on the data, the verdict is clear. H-World's Q3 results show a successful execution of its asset-light strategy. It's driving revenue beyond expectations and significantly expanding profit margins. And while their guidance suggests more moderate overall growth, the company is clearly transforming into a leaner, more profitable machine.
The data shows this strategic pivot is working wonders for profitability. The big question going forward will be how long they can sustain this incredible pace of franchise growth. So, what are your thoughts on H-World's asset-light strategy? I'd love to see them in the comments below. Thanks for joining this analysis, and I'll see you on the next one.